Guys, 3 stocks at 52-week lows. First one, McDonald's, 250.31, 52-week low of $245 back on October 6th of 23. So quite a while ago, and it's coming down quite nicely. Year to date, down 16%. 1 year, down 12%. Let's see, 1 month, down 8.5% in the last month. Mo, do they know how many reward points we have for McDonald's? Let's pull up our apps right here because,
question. We were just talking about that this morning.
I have McDonald's probably 5 breakfasts out of 7 every week. I get a sausage burrito, no picante, no mild sauce, and I get a large Diet Coke light ice. And I currently, after having 25,000 points get expired, I have 112,092 points. I told you that today.
So many.
What do you have?
Well, I had 4,000 expire, but I'm at 7,000. But mind you, I don't eat there. It's all coffee.
By the way, I don't consider McDonald's breakfast to be a bad breakfast. Like a sausage burrito, it's a tortilla, it's eggs. It's like if anybody tells me that's on, I'm like, shove it. Like I could make that at home in 13 seconds. Well, not 13 seconds, but anyhow, McDonald's. I love McDonald's. As one person once joked with me, I eat like a poor person, and I'm okay with that. Dividend yield, 2.6%. Eats up $4.6 billion of their $7.2 billion in free cash flow last year. That's a big chunk.
That is a big number. Wow.
Now, people who love dividends, I get it. I know it's nice to get that check. It feels like free money. It's not free money. It's taken out of the bank account. And I believe dividends are the last thing you should do with your money, but I get why people love it so much. You're at 21 times earnings, 25 times free cash flow. So there's a disconnect here, Mo, between that free cash flow and net income over the year, but the 5-year average is closer, really 6.1 billion versus 6.7. Now, guys, for those of you who are new to the channel, free cash flow is harder to manipulate than earnings. A lot of value investors basically say if their free cash flow is within 80% of net earnings, that's okay, but every situation is different. This could be a business that's invested a lot in the past, so it has to invest as it grows. Something like Amazon, they keep investing with distribution centers, things like that. You got to understand the story behind why the free cash flow and net income is disconnected. Or it could be fraud, like Enron was. Enron's free cash flow was very different than its net income, and that was a big indication.
It should be epic fraud.
Epic fraud, if McDonald's is a fraud. If McDonald's is a fraud, what's the purpose of living anymore?
The world's
a fraud. This is a simulation, which very well could be. Guys, we're at 57% gross margin. Now remember, a lot of these fees aren't selling burgers. It's the royalty. Yeah. It's the franchise fee. And I love McDonald's. They own the locations and they lease it to their franchisees as either a set rent or 8% or 9% of revenue, whichever is greater. If you worked at McDonald's for your first job, please drop in your favorite sandwich at McDonald's because they say it's the number one place that people get their first job. That's the number one job for the first job out there. So
believe it.
I love their cheeseburgers. I love their nuggets. I love the Big Mac. McDonald's is so good. And rest in peace to the Super Size Me guy. He just died this weekend. Yeah, 53 of cancer. Oh, wow. Remember, guys, here's our 8 pillars. And the 8 pillars aren't to sit there and make a decision to buy or sell on. It tells a story. The story it's telling me here is, this is our debt one. Mo, are you worried about this debt for McDonald's? 8.75 times free cash flow?
No.
Neither am I. This is McDonald's. This is a brand. I'm not worried about that. PE of 27, 5-year PE of 27, 5-year price of free cash flow of 30. But look at this return on invested capital, Mo.
Massive.
25% 5-year average, 27% over the last year. So the question is McDonald's a premium stock? Should you pay more for McDonald's than other companies?
I mean, I would more of the argument of yes than no.
100%. Right? The question is how much?
How much? Yeah.
That's the question with every company, guys. When you're valuing companies, it's all about determining, does this company get a premium to the historical average of 15, a discount, and why? McDonald's is an amazing brand. Is it a moat? If you ask 100 people for the number one fast food restaurant chain, what number is going to say McDonald's?
In the 90s.
You think so?
Yeah.
So let's check out what the analysts are saying about McDonald's. McDonald's. All right, decent EPS growth.
Yeah, pretty
$12 a share this year, going to almost $19 in 4 years. 3, 9, 8, 15, and 12% earnings per share growth. And revenue growth, my guess, Mo, is going to be low to mid single digits.
You're correct.
Oh, there you go. Out there, 4 or 5. So basically 4 or 5%. Makes sense. They're going to open more locations. They're going to do things like that. They're going to get nominal GDP growth. They're going to expand to other markets. Here's the interesting part. These are the countries that I visited McDonald's in the year I started doing that. United States and Canada, United States obviously all the time, Mexico in 2013, Great Britain in 19, Italy in 22, Switzerland in 22, Spain in 21, and Aruba in 23.
You're going global, huh?
I'm going global. So this is what, 8 of them?
So you're going to add.
And there's like
195?
30. But guys, these are my goals in life. So what is McDonald's worth to us? Mo, have you done McDonald's in your stock analyzer tool?
I just did it.
Here are my
let's
assumptions.
See what you have.
I did revenue growth of 2, 3.5, and 5.
Okay.
What'd you do? What do you think about this?
I did 3, 5, and 7.
That's probably better. Or maybe 3, 4.5, and 6.
Yeah.
So I'm going to do
I actually
that.
thought 7 was high.
So 3, 4.5, and 6. Profit margin. This might be low because you see this trend going up, 25,
Yes.
30. I did 24, 27.5, and 31. I don't know if I'm too low because you do see this trend getting better.
Correct. So I did 25, 30, and 35 because the trend was getting better. And I know 35 is a big jump.
And it has been a while since I've done this.
Mm-hmm.
So let me go 25, 29, and 30. Let me go to extreme. Let me go to 35, not make it even.
Okay.
And the free cash flow has been lower every single time.
Yeah.
So I'm going to go 23, 27, and 33.
Okay.
Now, PE, I did 17, 20, and 23 before.
I like that.
I was going to do 18, 21, and 24.
Okay.
Now, guys, that's the question. What premium are you willing to pay? Coca-Cola, Buffett paid 30 times earnings in 1987. We started buying it and still made 11.5% of his money, including dividends. Now, I'm telling you 18, 21, 24. If somebody said to me 25, I'd be like, yeah, makes sense. If somebody said to me 15, I'd be like, you're crazy.
Yes, that's
like, that's too low. And this is a big difference in my investing over the last few years. The big change has come from I'm focusing on better quality companies and paying a premium for them. So I saw the power of compounding over long periods of time without selling. And I can't do that on companies that have short-term problems. Mm-hmm. So that's a big difference I've had for my investing. And that's why if you watch this video from 3 years ago, it's very different numbers. I didn't understand the true value of paying for a quality business. Wouldn't you agree with that, Mo?
Yep, absolutely.
So that's really changed. 9% desired return. The market does 9 or 10%. There's no margin of safety in here. And I'm going to do that for the next 2 companies as well. But you got to have a margin of safety. You got to put in a higher price because if you're just going to keep 9%, just buy a low-cost ETF.
Buy an ETF.
Well, what are you going to say?
I want to see your numbers.
Okay. I'm at the Analyze button. Low price, 140 to 150. High price, 300 to 320. Low price of 200 to 220. It's on my watch list at 175. What's yours?
We're about those same numbers. 115 to 136 on the low, 175 to 210 in the middle, 260 to 314 on the high.
Yeah. Okay.
About the same area.
Yep. Stock number 2, Johnson and Johnson.
Okay.
Johnson, I think they have a big dividend, Mo. They do.
They do.
3.3%. The stock's currently at 144. The 52-week low was a month ago at 143.13. It's so close. So close. Let's see that 10-year chart. Year to date, down 10%. So, how do you know if a stock is down this year? If it's not named NVIDIA.
Correct.
Like literally, I think I saw something like it's half the gains of the S&P or something crazy like that. I don't know if it's true or not. Either way, so it's nice to see some companies getting cheaper and cheaper as time goes on. Okay, you got to scratch out this net income. $38 billion, that's clearly a fluke. Because even if you look at the 5, I mean, yeah. So bottom line is I'm focusing on the free cash flow here. And that 5-year net income, because of this fluke, has definitely driven up. So I'm not even worried about this disconnect of $1.5 billion in the 5-year average. So 9 times earnings, again, ignore. Focus here on the free cash flow because this earnings number is driven by this one-time net income. I think it was a income tax or something like that. Go ahead, Mo.
The dividend bothers me so much, but at the same point, it really doesn't because what else is Johnson & Johnson going to do with their money?
Buy back shares.
Yeah, they should be buying.
I don't know if 19, I don't know if that's the right price. I'm just looking at going.
When you consistently have these 52-week lows, you have to be thinking about that and cutting your dividend.
Yeah, but the hard part is, guys, how does the company come out and say, hey, remember that 3.4% dividend that you loved? Yeah, it's gone. It's hard to do.
Abused.
That's why we like the special dividends. Yep. The Costco special dividend.
I love it.
We have a lot of cash. Here's a one-time special dividend of $20. Mm-hmm. Makes everybody feel warm and fuzzy. Doesn't commit you to long-term. It's a good, stable way for a company to give money back to investors without committing to something that they might get punished for later. Mm-hmm. Right? Okay, let's check out those 8 pillars. Almost an 8-pillar thriller. Cash flow is down over the last 5 years, not a big deal. Analyst estimates, slow and steady EPS growth.
I was going to say, it has to be super low.
I mean, 1076 to 1240 in a matter of 4 years. That's so guys, it's slow, but it is Johnson & Johnson. What is their ROIC? Growing too. Well, not growing.
12 about.
12 points.
Yeah.
So it's reasonable. So I think your valuation here, in my opinion, I'm not assigning this 20 plus. I'm not assigning this 12. It's got the Johnson & Johnson appeal. It's the everything company. They do a lot of different things, pharmaceuticals, everyday brands, things like that. So can I understand 15? I actually can. Can I understand 18 or 19? I actually can. But by all means, if you think differently, that's why you have this. And guys, remember, 52-week low is a great place to start looking for companies. Just because it hits a 52-week low does not mean it's a good deal, but it's a great place to start. As Mo was talking about, hey, at 52-week lows, they got to start thinking about these things. When you see great companies hit those lows, maybe more momentum to come, it's a good time to sit there and do a high-level stock analyzer thing. Go, for those of you who have the software, go in there, put your numbers in. If it's close, start paying attention, start doing more work, talk in the community. Because the next thing you want to do is, when you're ready to buy, you buy with confidence. The confidence needed is the confidence that if this stock fell from 144 to 70, that you go buy some more as time went on. And it's hard to do that. That's the emotional part of investing that's so difficult, especially with companies like NVIDIA flying high.
Oh, yeah.
So managing emotions is the only true great way. Everybody can buy stocks based on fundamentals, but the way you're going to make a ton is by handling those emotions. So if you want to get better at that, and you want to use this community, our inner circle, and these tools to get better, click the link below, sign up. We have a great trial offer for people. Go sign up. Let's pull up the last time I did Johnson & Johnson. Jeff Johnson, May 5th.
Okay.
I actually did 20 times PE on that one. So I'm going to go 16, 19, and 22.
Okay.
But for revenue growth, I did 2, 3, and 4%. I did 18, 21, and 24 on, why did I do that? Seems low, Mo.
I did 18, 22, and 26 for profit margin.
Oh, yeah, because the 24.5 is here, the 21% 10-year average. So there's a reason why. Oh, but remember, it includes that
it's that
fluke.
That's right.
That's why.
Right.
So I need to focus more on that. You know, I'm just going to make both of them. They were 22 across the board below. I'm going to do 19, 22, and 24.
Okay.
Okay. Now, PE, I did 16, 19, and 22. Same with price of free cash flow, my 9% across the board.
Okay.
Stocks at 144.44. Hit the analyze button. All right. I got a low price of 103, high price of 185, middle price of 143. It's on my watch list at 140, probably to start selling puts and take a deeper look to sell puts at lower prices than 140. What'd you get, Mo?
This one you want to own?
Yeah, I think it's in my 33 stocks I want to own forever.
Yeah. I'm at 86 on the low end, 119 in the middle, 162 on the high end.
Okay. Sounds good. Final company, Mo. CVS.
This is an interesting one.
It is an interesting one. Low margins, 2%, 2.25. This thing is down a lot, 20% in the last 6 months, 33% year to date, down 33% year to date. You've seen Walgreens, they got butchered as well.
Yep.
So is this one to take a deeper look at? I like CVS more than Walgreens, even though this one's tough still because of this bad return on invested capital. Used to be flipped. Walgreens numbers looked a lot better. I exited Walgreens going, I'm out. Like, I don't like the way the company is going. I don't like this debt level. And same with here. Guys, $67 billion market cap, $230 billion enterprise value. For me personally, I'm out. Even though a lot of it is, the margins suck. And look at this dividend. Now, the dividend's affordable, 4.7%. That's why they have this dividend. 52-week low of $52, just actually today. It hit the 52-week low today. So
I think a good take home from this is just because something's at a 52-week low doesn't mean go buy it. It could be there for a reason.
And by the way, it hit its all-time high, July 29, 2015, a year before the Cavs won their amazing 3-1 comeback victory.
Wow.
$113 a share.
Wow.
And it's been going nowhere since.
And nowhere but down.
Actually, going back 10 years, it's down 31% last 10 years.
Wow.
Now remember, it doesn't mean it's a bad company just because the stock has gone nowhere.
Right.
But what's it gonna? You gotta really have this thing cheap, in my opinion, in order to justify with a low return on invested capital. Analysts, I mean, look at this EPS growth for analysts though. $7, $8, $8.80, $10.20, $11.36.
Pretty significant.
Yeah, double-digit growth. Revenue, I'm actually surprised, 4%, 5%, 6%. All right, let's pull up Stock Analyzer tool. So guys, here's a Stock Analyzer tool that I did just a month ago. I did 3%, 4.5%, and 6% revenue growth. Profit margin, I did 2%, 2.25%, and 2.25%, and 2.5%. Their free cash flow in the last 10 years and 5 years have been almost double what their earnings were. So I did 375, 425, and 475.
Okay.
Now for PE and price of free cash flow, this is where I punish them for that margin of safety. Even though they have great real estate and they have great locations and they probably have a pretty stable business there, I did 13, 16, and 19.
Okay.
I did 9% across the board. Hit the analyze button. Again, guys, if you want to use these tools to make better decisions, but also have the community to manage your emotions, go click that link. Wow. Low price. Let's focus on free cash flow. 150, high price at 300, middle price at 215. Oh boy.
It's really green.
Guys, we got to have a community chat about the stock. And if you want to see our last video we did about the 3 stocks at 52-week low, watch the next video. Thank you for your time.